Central banks were once seen as the calm pilots of the global economy. A single rate decision could steady markets and reset expectations. Today, every move seems to create a new risk somewhere else. Inflation, debt, and politics are now pulling policy in opposite directions. To understand this, we need to look at how central banking quietly changed. Central banks were once the most powerful stabilizers in modern economies, able to calm markets with a single rate decision or policy signal. Their credibility rested on a simple logic. When inflation rose, they tightened. When recessions appeared, they eased. Over time, this role expanded far beyond inflation control, as cheap money supported governments, banks, and asset markets. The problem today is that this system no longer works smoothly. Public and private debt is far higher than in previous cycles, making economies unusually sensitive to rate changes. When central banks raise rates to fight inflation, debt servicing costs surge, threatening financial stability, government budgets, and highly leveraged sectors. When they cut rates to protect growth, they risk reigniting inflation and inflating asset bubbles that widen inequality. This creates a narrow corridor where every move carries significant risk. Markets now react instantly to even subtle signals, forcing central banks to communicate with extreme caution rather than clarity. At the same time, governments depend on central banks more than ever to manage crises, even as fiscal policy remains constrained by debt and politics. This blurs the line between independent monetary policy and political pressure, further complicating decisions. Central banks are expected to control prices, stabilize banks, support employment, and preserve financial markets all at once, a combination no single institution was designed to handle. The result is a paradox of power. They appear more influential than ever, yet feel more constrained. Each decision trades one problem for another, rather than delivering a clean solution. Rates no longer operate as a simple tool. They function as a delicate balancing act across inflation, debt, growth, and credibility. This is how central banks became trapped not by a single mistake, but by the accumulation of expectations, leverage, and interdependence that reshape the entire economic system. If every rate decision now creates new risks, how can central banks act decisively again? After years of near-zero rates, central banks unintentionally trained markets, governments, and households to expect permanent cheap money, a shift that now deepens the trap. Investors built strategies around endless liquidity, treating risk assets as one-way bets because policy would always step in. Governments structured budgets, assuming low borrowing costs far into the future, locking in spending commitments that look fragile in a higher rate world. Households stretched into long mortgages and variable loans, believing financing would remain inexpensive. When inflation returned and central banks tightened, this entire architecture was shaken at once. Markets became volatile, not because the economy collapsed, but because assumptions were wrong. The sudden repricing of risk-forced banks, funds, and corporations to scramble for liquidity and hedge exposure. Central banks responded with emergency facilities, even while raising rates, revealing how entangled they had become in financial plumbing. This dual role, tightening policy while backstopping markets, confused signals and weakened credibility. Meanwhile, governments leaned on central banks to avoid disorder, subtly pressuring them to move cautiously despite inflation risks. Each side needed the other. Fiscal authorities relied on monetary stability, and central banks relied on fiscal cooperation to manage debt and banking stress. The problem is that this coordination emerged in crisis rather than by design. Cheap money had blurred boundaries so thoroughly that retreating from it proved politically and technically difficult. Markets now test central banks constantly, betting on how long they can keep rates high before financial strain forces a reversal. This dynamic turns policy into a game of endurance rather than strategy. The legacy of easy money did not just inflate asset prices, it rewired expectations across the system. Undoing that wiring without triggering instability is the core challenge central banks face today. That dilemma defines their power, limits, and credibility going forward for every decision. If markets are constantly testing central banks, how can they regain authority without breaking the system? Central banks no longer set interest rates in a vacuum because debt has become the invisible force steering nearly every decision. In earlier decades, policymakers focused mainly on inflation and employment, assuming governments, banks, and households could absorb rate changes without systemic stress. Today, that assumption no longer holds. Public debt is at record levels in many countries, meaning even small rate increases translate into massive additional interest costs for governments. This forces central banks to weigh inflation risks against fiscal instability before acting, something that was never meant to be part of their mandate. The same dynamic applies to the private sector. Banks, corporations, and households are far more leveraged than in the past, making them unusually sensitive to tighter financial conditions. When rates rise, loan defaults increase, investment slows, and financial markets wobble, pulling central banks back into crisis management mode. This dependency creates a paradox. Central banks are supposed to be independent guardians of price stability, yet they now operate inside a debt system that limits how far they can go. Markets understand this and price in expectations that central banks will eventually soften their stance, even if inflation remains sticky. That belief reduces the effectiveness of policy, because credibility erodes when words and actions appear constrained by debt rather than economic fundamentals. Governments also add pressure, implicitly or explicitly, to avoid aggressive tightening that could destabilize budgets. The result is a slow, cautious approach that frustrates both inflation hawks and growth advocates. Rates no longer function purely as economic tools. They have become political and financial balancing instruments. This shift changes the entire character of monetary policy. Instead of guiding the economy, central banks are increasingly managing a fragile debt ecosystem where every move risks tipping something over. Debt, not inflation alone, now defines the boundaries of what is possible. If debt sets the limits of monetary policy, can central banks still claim real independence? Financial markets today move at a speed that central banks were never designed to manage, and this mismatch has deepened the rate trap. In earlier eras, policy decisions filtered gradually through banks, businesses, and households, giving policymakers time to observe, adjust, and communicate. Now, algorithmic trading, instant information, and global capital flows mean markets react within seconds to every hint of policy change. A single phrase in a press conference can trigger massive swings in bonds, currencies, and equities, forcing central banks to respond defensively rather than strategically. The speed reduces their room to experiment or signal nuance. Officials must choose words carefully, knowing that ambiguity can be interpreted as weakness and clarity can cause volatility. Markets have learned to test boundaries, probing how far central banks are willing to go before stepping in to stabilize conditions. This dynamic shifts power subtly from policymakers to investors. Instead of markets following policy, policy increasingly follows market stress. When yields spike or liquidity tightens, central banks often soften their stance or provide emergency support, even while inflation remains elevated. That pattern reinforces expectations that financial stability will always be prioritized, weakening the deterrent effect of tighter policy. At the same time, global interconnectedness amplifies every move. A decision in one country ripples across others, affecting exchange rates, capital flows, and banking systems far beyond its borders. Central banks must therefore consider not only domestic conditions, but global reactions, further narrowing their freedom. The result is a reactive cycle. Markets test limits, central banks stabilize, markets test again. Over time, this erodes credibility and makes consistent policy harder to maintain. Rates are still set by central banks, but the range of acceptable choices is increasingly shaped by how markets might respond in real time. This is how financial speed has turned monetary policy from a guiding hand into a constant negotiation. If markets react faster than policymakers can plan, who truly controls monetary policy in practice? Central banks are also trapped because inflation has become harder to read and slower to control than in the past. Prices are now shaped by global supply chains, energy shocks, labor shortages, and geopolitical fragmentation rather than only domestic demand inside national borders. When inflation rises, rate hikes do not always cool the right pressures, yet they still slow investment, depress housing, and strain debt across the entire financial system. This makes policymakers deeply uncertain about how much tightening is actually useful versus merely painful. At the same time, inflation expectations are far more fragile after recent shocks. If central banks move too slowly, households and firms may assume higher prices are permanent and demand faster wage increases, creating a self-reinforcing spiral that is politically and economically dangerous. If they move too fast, they risk triggering banking stress, market instability, or a deep recession without fully solving the price problem. Communication therefore becomes almost as important as policy itself, but markets often interpret cautious language as hesitation or weakness. This blurs credibility and pushes officials to sound tougher than they may ultimately act. The deeper issue is that inflation is no longer a single variable central banks control alone. It is embedded in trade policy, energy security, climate transition, industrial strategy, and geopolitics, areas largely outside their legal authority. Meanwhile, governments expect central banks to deliver price stability while also protecting employment, banks, financial markets, and public finances at the same time. These conflicting expectations widen the trap. Every decision is judged not only by inflation outcomes, but by side effects on growth, inequality, stability, and political trust. As complexity rises, interest rates increasingly look like a blunt instrument in a messy world, making decisive action far harder even when the need appears clear to everyone watching for everyone. If inflation is shaped by forces beyond central banks, can interest rates really remain the main tool of economic control? Another reason central banks are trapped is that banking systems have become tightly intertwined with policy itself. Over years of quantitative easing, central banks bought massive amounts of government bonds and mortgage securities, turning their balance sheets into pillars of the financial system. When rates rise, the value of these assets falls, creating accounting losses that can unsettle confidence even if institutions remain solvent. Commercial banks face similar risks, holding long-term securities funded by short-term deposits, which makes them vulnerable to sudden withdrawals. This link means that aggressive tightening can unintentionally stress banks, forcing central banks to provide emergency liquidity while still fighting inflation. The result is contradictory action that confuses markets and weakens credibility. At the same time, financial regulation has struggled to keep pace with new forms of risk in shadow banking, money market funds, and leveraged investors who react quickly to rate changes. When stress appears, central banks become crisis managers again, blurring their inflation-fighting role. Governments also rely on central banks to maintain market stability, subtly pressuring them to act as backstops rather than strict guardians of prices. This web of dependence makes clean policy almost impossible. Every rate decision must consider not only inflation, but banking stability, market plumbing, and political consequences. Central banks thus operate in a permanent state of balancing, where success in one area often creates vulnerability in another. Over time, this dependence reshapes expectations among investors, voters, and officials, who all look to central banks for protection today. If central banks must also be the system's firefighter, can they still act as its strict referee? Central banks are increasingly trapped because political pressures pull them simultaneously toward easier and tighter policy. Governments want low inflation to maintain credibility, but they also want cheap financing to fund spending, support employment, and avoid recessions before elections. This contradiction places central banks in the middle of competing demands that were once separated. Formal independence exists, yet informal influence has grown through public statements, fiscal dependence, and financial stability concerns. When rates rise, politicians warn about job losses, mortgage pain, and slower growth. When rates stay high too long, pressure intensifies to cut, even if inflation is not fully under control. Conversely, when inflation accelerates, the same leaders demand tougher action while quietly hoping markets remain calm and borrowing costs manageable. This dual pressure narrows the range of acceptable decisions. Central banks begin to communicate more cautiously, avoiding clear commitments that could anger either side. Markets read this caution as uncertainty, which weakens policy transmission and forces officials to react more frequently. The political trap deepens during crises. Governments expect central banks to act quickly to stabilize markets, even if doing so contradicts their inflation goals. Each intervention blurs boundaries further and makes independence harder to defend. Over time, voters shift expectations, viewing central banks less as technocratic guardians and more as tools of economic management. This politicization undermines trust and makes future decisions more controversial. The rate dilemma, therefore, is not only economic or financial. It is deeply political, shaping what central banks can realistically do in practice. If central banks are pulled in two directions by politics, can they still act independently when the next crisis arrives? Modern central banks are no longer operating only for their own economies. Every major rate decision now spills across borders. In a globally connected financial system, a move by the US Federal Reserve, the European Central Bank, or the Bank of England immediately affects currencies, capital flows, and financial stability in dozens of other countries. When a major central bank tightens policy, emerging markets often face capital outflows, weaker currencies, and rising import costs, even if their domestic inflation is already cooling. This forces smaller central banks to follow rate hikes they might not otherwise choose. When major banks ease policy, asset bubbles can inflate elsewhere, creating instability down the line. This interdependence traps policymakers in a collective dilemma. No central bank acts in isolation, yet formal coordination is rare and politically difficult. Each institution must balance domestic needs against global consequences it cannot fully control. The problem becomes sharper during crises, when emergency measures in one country can destabilize others. Liquidity support in advanced economies may draw capital away from developing nations, worsening inequality and financial stress. At the same time, global investors react to perceived weakness by rapidly shifting funds, amplifying volatility. Central banks thus spend as much time managing international spillovers as they do managing domestic inflation. This reduces their autonomy and forces them into reactive decision-making. The rate dilemma, therefore, is not just national, it is global. Policymakers are trapped inside a system where independent action is technically possible, but practically constrained by the behavior of markets and other central banks. If central banks are bound together by global spillovers, is true monetary independence still possible in today's world? Beyond rates, balance sheets, and markets, the deepest part of the trap is trust. Central banks do not only control money, they manage expectations. When people believe policymakers are credible, inflation is easier to control and markets remain calmer. Today, that trust is fragile. Years of emergency interventions, sudden policy shifts, and mixed messaging have blurred the public's understanding of what central banks truly stand for. Many households now see them less as neutral guardians of stability and more as institutions that protect financial markets first. This perception weakens their authority even when they make technically sound decisions. At the same time, markets have learned that central banks rarely tolerate deep pain. Whenever stress appears in banking or bond markets, support often arrives quickly. This policy put makes investors less cautious and more speculative, which then forces central banks to intervene again when bubbles wobble. The cycle erodes credibility on both sides. Communication has become another vulnerability. Officials must sound tough on inflation while secretly worrying about financial stability. The contradiction seeps into speeches, press conferences, and forward guidance, making signals harder to interpret. Confused markets react with volatility, which pressures policymakers further. Trust also varies across countries. In places with weak institutions or political interference, central banks face even greater skepticism, reducing the effectiveness of rate policy. Over time, declining trust turns monetary policy from a technical tool into a political battleground. Once credibility weakens, regaining it is far harder than losing it, even with correct policy choices. If trust is now central banks' most fragile asset, how can they rebuild it without causing a painful recession? Escaping the central bank trap will not come from clever rate moves alone. It requires a broader reset of the economic system that created the dilemma in the first place. Central banks cannot fix debt, demographics, or geopolitics, yet they are expected to manage their consequences. Real escape begins with governments taking responsibility for fiscal discipline, structural reform, and productivity, rather than leaning permanently on monetary policy. That means reducing excessive reliance on cheap debt, investing in growth-enhancing areas, and accepting that not every slowdown can or should be prevented. Central banks, in turn, must gradually narrow their role back toward price stability and financial oversight instead of being the economy's all-purpose problem solver. This will require clearer communication, less emergency intervention, and a willingness to tolerate short-term pain to rebuild credibility. Markets and voters must also adjust expectations, accepting that stability does not mean zero risk, and that policy cannot protect every asset or job at all times. The transition will be politically difficult because it challenges the comfort of easy money, constant support, and delayed trade-offs. Yet the alternative is permanent constraint, where central banks remain stuck balancing impossible demands. Escaping the trap is less about finding a new tool and more about redistributing responsibility across fiscal policy, regulation, and real economic reform. If this realignment happens, rates can return to being a genuine economic instrument rather than a fragile tightrope. If it does not, the dilemma will only deepen with the next shock. If the trap is political as much as economic, who will make the first move? Governments, markets, or central banks? If you want deeper breakdowns of how policy, markets, and global economics connect, stay with Wealth Woven and keep thinking beyond the headlines.